and thanks everyone for joining us for this webinar. Today we're going to be looking at specifically at limited company directors, limited company contractors, basically those who work through their own limited company. And we're going to touch on the IR35 situation as well. Mostly we're going to look at what's going on during the COVID-19 crisis, and we're going to talk about all of the array of packages which are out there. And as you will know, limited company directors have been largely excluded from these, and we're going to talk about that, and we're going to talk about what IPSE is calling for as well. So my name is Andy Chamberlain. I'm the Director of Policy at IPSE, and I'm joined today by my co-presenters, Ina Yordova, who's the Senior Researcher. Ina, are you there? Ina can't hear me. Okay, Ryan, are you there?
I am.
Oh, Ryan Barnett is our Economic Policy Advisor. So hopefully Ina will be back with us shortly. But at the moment we can't hear from her. So it'd be great if you... Oh, Ina, is that you?
Yeah.
Great, glad you're there. Okay, fantastic. So for the benefit of everyone watching at home, we are doing this for each from our own remote locations, of course. So you know, we're all on lockdown too. So we've managed to make it work. We've been doing this once a week, so hopefully the technology won't let us down, and we'll all be able to hear each other. But I would be very grateful if you could let us know whether you can hear us now and see the slide. You should have one slide up in front of you with our names on them. If you could just put in the questions box that you can see and hear us, I would be very grateful. Thank you. Okay, while you're doing that, we will begin the presentation. So what we're going to look at is what's the government announced, and what support are you as limited company directors entitled to now? And what we're going to talk a bit about what IPSE is doing to represent our members and the self-employed generally, and we're going to point you to places where you can find more information as well. And there's a sort of a death by links slide at the end, which those links will be sent around to you later on. And while I'm thinking of it, we've also started sending out feedback forms. So I think tomorrow you will receive a feedback form on the webinar. Let us know what you thought of it. We'd be really grateful if you would fill that in, because it helps us to shape the next webinars that we're doing. And also included in there will be the links that we're going to include in here too. This is being recorded, and a recording of this webinar will be available on our website as well. And you can go onto our website now and see the previous webinars that we've done. There's now 5 or 6 in the chain that we've been doing every week since the coronavirus has really taken hold. Okay. So IPSE lobbying. I thought it might be helpful just to sort of catch up quickly on all the things that we've been doing throughout the crisis. So going right back to February, when, you know, way before the lockdown measures were in place, it became pretty clear that the coronavirus was going to be not just a health crisis, but an economic crisis too, and that contractors and self-employed people were going to be hit very hard, very early by this. So we wrote to the health minister and to the Treasury and to the DWP, and we said, look, could you, we're going to need something put in place here for self-employed people, because their income is going to be hit very, very hard, very quickly. So that was when it started. We then we started doing some media on it as well. The media picked up on what we were doing, and we built up a bit of a campaign. So we what we were calling for then was what we were calling a temporary income protection fund for self-employed people, and the idea of that would be that it would be available to all self-employed people and those that work through their limited company as well. So sole traders and limited company directors, they should all be eligible for this fund that we were calling for. We wrote to the Prime Minister. We had lots of associations and organisations co-sign that letter with us, and we got a petition going, and many of you might have signed that petition. We had over 200,000 signatories in the end. We submitted some evidence to the Treasury Select Committee, and you can see what we submitted on our website. There is on our website our submission, and I was actually in the Treasury Committee. I say I was in it, of course I was doing it virtually, but I gave evidence to the committee on Tuesday morning, and you can see that full evidence session on our website as well. and you can see exactly what we were calling for at the Treasury Committee. We've also given evidence to the Bay Select Committee too, so we've been doing a lot of lobbying on this. Now, of course, what all of that work did is it led to the government setting up something called the Self-Employed Income Support Scheme, which we're going to talk about a little bit, but that is not for limited company directors. We said it should have been, but it wasn't. So we will talk about that a bit, but that is not for company directors, unfortunately. We are still talking to Treasury about what they can do for limited company directors, and that's what we're going to talk about more here today. Now, I just want to, before we get into all of that, I also want, because I know that a lot of people who have tuned into this are also very concerned about IR35, and many of you will know that we at IPSE is kind of the core issue for us, and you might even know that for me in particular, I am always banging on about IR35. That's what I'm known for. So I'm going to bang on about it a bit more. Sorry about that. But I promise you, this is our only slide on IR35. So I'm just going to rattle through this. I know it looks a bit busy, but I'm going to rattle through it. So yeah, look, one of the things that happened during the coronavirus, when it became clear that this was going to hit us hard, is that the government announced a delay to the private sector changes. I won't go into those now, but basically it was going to make IR35 worse, and lots of people were already suffering as a result of this change, which was imminently about to come in this April. Government said, right, we're not going to do that. In March, they said, no, we're not going to do it. We're going to pull it. We're going to delay it by a year, which we said, okay, great, good. And we wanted them to do that anyway, but we thought it was very sensible given that the coronavirus was just about to hit us with its full might. The government intention is to put the legislation into this finance bill that's going through Parliament at the moment. Next week, they've got a second reading of the finance bill. The legislation is going to be part of that. So they're looking to lock this in, this legislation, but it won't be effective until April 2021. Now, it was supposed to happen on Monday. There were last-minute changes to the order paper, sorry, the second reading of the finance bill, that is, which includes this. There was last-minute changes to the order paper for Monday. Now it's, sorry, Tuesday. Now it's next Monday. That's when they're doing it, right? They want to do this on Monday. That's when it's scheduled for in Parliament. But Jacob Rees-Mogg, the leader of the House, has said that there will be no divisions next week. Divisions is basically voting, where the MPs say aye, nay, and all of that. There aren't going to be any divisions because I don't think they've quite worked out yet how they're going to do that with the technology, because you may have seen there was Prime Minister's questions yesterday with just a few people scattered in the chamber, and then most people joining via screens and link up and Zoom and all the rest of it. They haven't worked out how to do the voting yet. Now, they may try to push this through without a vote, but what we're saying is, and this refers to my final bullet point here, is we're trying to get people to contact their MPs and get their MPs to contact the Speaker of the House of Commons and say, Speaker, we must have a vote on this. This is a contentious part of the bill. If they do that, then it means that they won't be able to get it through next week. So we are trying to make we don't want the government just to shove this through without MPs having a proper think about it, basically. So if you could contact your MP and let them know that this is coming in and let them know that they should ask the Speaker for a vote on it, that would be very helpful. Now, there might be some things you might want to mention, and the House of Lords Committee on it's called the Sub-Finance Bill Committee, was doing an inquiry into the IR35 provisions. We gave evidence at that committee, and we, of course, told them that it was a very bad idea. Now, this committee was quite instrumental in getting the legislation delayed because they called for it the day before the government announcement. Lord Forsyth is the chair. He has since written to the Financial Secretary, and he's basically asked some very good questions. He has said, now look, are we right in thinking that the reason why you delayed it was to avoid burdening business with this at such a difficult time? And if we are right in thinking that, why are we locking this in for 2021 when we can't be sure that businesses won't still be struggling? There's no end in sight at the moment, unfortunately, for this terrible recession, which we're just about getting into now, and which Ryan is going to talk about a little bit more in the coming slides. So why are we going to lock that in for now? Now, the delay came too late for some people. A lot of clients stopped engaging their contractors altogether. They were terrified of, the clients were terrified of IR35, so they basically cancelled all these contracts. Now, the question is, what is the government doing to help those contractors now? And that is another question that Lord Forsyth put to the Financial Secretary. He pointed this out and said the timing of this couldn't have been worse for some people. So good that you've delayed it, but what about all the people that had already lost their contracts due to this about to come in, and now they're being excluded from these schemes as well? Now, we are pushing for the removal of the legislation from this bill, this finance bill, and of course beyond. But you can help us by contacting your MP and make them aware that this is coming up on Monday. And there's a little link at the end of this where I've written about this a bit, and you can also find out who your MP is via a link on there if you don't already know. So if you could help us out with that one, that would be great. Okay, that's my IR35 bit done, I promise. So so back to the problems around the coronavirus. Now, this all comes down to dividends. The real problem for limited company directors, and the reason why the government see them as one of the most challenging groups to support, is because they say we don't know how to easily deal with the issue that a lot of directors will pay themselves a dividend as well as a small salary. They say that there is no easy way to distinguish dividends from a director's company profits, as opposed to dividends from an investment. In other words, you could have a share portfolio and get dividends, or you can have your own company and get dividends from that. And the government has no way of knowing which is which. That is the government line, and I do think that's a genuine hurdle there, right, for the government. However, there are some who say, well, actually, the government doesn't like contractors, right? And you can see with the IR35 legislation and various other things that they've said and done in recent years that they are sceptical about contractors, and perhaps they're just being unsympathetic towards them. Now, funny enough, Mel Stride, the chairman of the Treasury Select Committee, put this very point to me on Tuesday when I was giving evidence there. He said the same thing. He said, well, there is that view, isn't there, that perhaps that's how they feel about it. And of course, he was the financial secretary this time last year, so he was in the Treasury, and perhaps he was saying that. I wasn't sure if he was saying that's his view. I mean, he didn't say that, but so there is that concern that is the government actually just unsympathetic? Now, I'm speaking to people in the Treasury, and they're saying that is not the thing. It is all about this problem over dividends. So I'm taking their word for that for now, and for that reason, I'm trying to come up with ways around this dividend problem to help them get over that hurdle so that they can get help to limited company directors. The problem with dividends is that's the reason why they weren't included in the self-employed income support scheme, say the government. And they are, of course, only partly covered by the coronavirus job retention scheme. And we are going to talk about that in quite a bit more detail later in this webinar. IPSE is unconvinced by this. We're trying to say to them, pay now, claw it back later. In other words, if you overpay someone, if they've got dividends from somewhere else and it turns out that was the case, you can get the money back later on. But right now, limited company directors really need some cash injection because they have been left out of these other schemes so far. And we're saying, look, just simply ask claimants where the dividends come from. When you go online to say, I'd like to apply for the scheme, you can have a question there that says, okay, you see you got dividends, how much of those dividends have come from your own limited company? And if you lie, then you could be in very, very serious trouble, possibly even fraud type trouble, right? So we're saying, I think you'd get a lot of compliance if you just did that. Anyway, we will talk about all this a bit more later. The problem is that directors, they can get, if you do have employees as a limited company director, then you're looking at this and you're saying, well, I can get my employees paid up to 80%, well, 80% of what they normally get, and they can stay at home furloughed and get that money. But what about me? And when we come out of this crisis, this company won't be around anymore because I won't be able to survive, and those employees will have nowhere to come back to. The ONS recently brought out some statistics which showed there were 710,000 sole company directors in the UK. So these are solo company directors. Now, some people will also have a partner in their business as well. So there could be even a bigger group than that that's affected. And if you look at the wider world of limited company directors, then some people say you're looking at about 2 million. So this is a big group of people that are making quite a lot of noise and trying to get the government to listen, and we are part of that noise. But I'm going to hand over now to Ryan, who's going to talk a little bit about the economic background to all of this.
Can you go back a slide, Andy?
Oh, sorry, did I go past? Oh, I did. I keep on pressing 2, sorry.
So, it's my job at IPSE to look into the economy and freelancing, and I work very closely with INA on something called the Freelancers Confidence Index, which looks at how much freelancers and contractors are earning, how much work they're getting, and how successful they are, and also how they feel about the economy. But I'll come on to that in a second. So this first stat I've got here, which says that this is probably going to be one of the worst recessions, certainly in living memory. We already know that. And that number, that 35% dip in GDP, was predicted by the Office for Budget Responsibility about 2 weeks ago, and that's monthly. And they've put a scenario together. They don't want to call it a forecast, but they put a scenario together where they reckon that the lockdown will cause a very significant, very sharp dip, as we are seeing, in GDP month on month, but then that will recover quite quickly. However, that's coming for quite a lot of criticism because it will probably take quite a while to get back to normal. However, a lot more data has come out this morning, and it is quite bleak, but the Bank of England predict that this is possibly the worst recession in about 300 years, going back to 1709, which was the Great Frost, which effectively gutted all the agriculture in Northern Europe. And I guess the main issue with what's happening at the moment in terms of the lockdown is that it's a complete collapse of both supply in terms of labour and produce, but also demand, because people just aren't spending money, and obviously a lot of people are unemployed. I think about 25 million people have applied for income support in the US in the space of about 3 weeks. You've had 1.5 million universal credit claims, lots of people being furloughed, of course. And just to put that into context of something we've experienced a bit more recently, that will probably equate, if that's right, and the data that's come out this morning from market data looking at manufacturing and services actually predict this could be worse, and that you're possibly looking at a 7% collapse in GDP for the UK over this year. Something similar has been predicted in France and Germany as well, and that is worse than the financial crisis by at least a percentage. It is about the same as the Bank of England's worst predictions for a no-deal Brexit, which was about 8%, I think. And the real thing with what's happened with the lockdown is that even though you can compare it in terms of scale to something like the financial crisis, a no-deal Brexit, the Great Depression, etc., actually one of the things that we haven't experienced really like this before is that the sheer speed of the lockdown and the sheer speed of the contraction of the economy means that this is a lot more severe, and that we're possibly looking at a longer period of recovery. If you look at the financial crisis, that 6% or so drop in GDP happened over about 18 months before it bottomed out and slowly tried to recover. This is happening in the space of a month, which is very severe. And in fact, economists are trying to update their data all the time and predictions because it's happening so quickly. And there's other effects, of course. You might have seen the oil prices completely collapsed. Inflation started to dip, which is good, I guess, if you have the money to spend at the moment. Of course, not on leaving the house. And we started to see impact on different sectors. So I guess the big one quite early was tourism, and then anyone that worked in events, because those are the things that started to be cancelled quite quickly when we knew this was happening. But more long term, the creative sector and construction are really big areas to worry about. All of those sectors, of course, having a high propensity of freelancers, particularly the creative sector. if there's any EastEnders or Coronation Street fans listening, you'll know that those shows have been limited to about, I think, once or twice a week instead of like 4 times a week or whatever it was. And the reason for that is that most of the people that work on TV shows like that are freelance, and you can't work from home and you can't film. So they're rationing out the TV shows so that they last longer, because they're going to run out of new episodes and new content in a couple of months' time. And a lot of people that work on those TV shows are freelancers, and we're hearing people are getting work cancelled on film projects, for instance, or tours and all sorts, theatre productions, all the way up until the end of 2021, which is obviously quite alarming. So Ina will describe the survey we've done recently in looking at how this has affected contractors and freelancers. But we also have our FCI, which I spoke about before, which is a quarterly index looking at earnings, how much people are working, and their confidence about the economy. So Andy's come over to this graph now, and you'll see, hopefully you'll be able to read it. The blue line is business confidence among the freelancers we speak to, and the orange line is economic confidence. And this is since 2014. Now, you may have noticed that most of the numbers dip below the 0 line into negativity after the Brexit referendum. Most of the troughs that you can see on this graph, which Ina and I doing the FCI speak about quite a lot, tend to correlate to political events. So the referendum is the major drop there. And then every other major event, particularly for economic confidence, is connected to political events. So you'll see around Q2 2017, general election, and then the other dips are associated with Brexit deadlines last year primarily. Business confidence, however, is slightly detached, especially around the Brexit period. And actually, if you look at the previous results, yes, there was a dip in business confidence amongst freelancers when the referendum result happened, but the biggest dip on record until very recently was the rollout of IR35 reforms into the public sector. And we've actually started to see, if you look at the end of the graph, the last couple of results have started to see a dip again as we were approaching the original April deadline for the rollout of IR35 into the private sector. Now, we can't reveal our results right now because they've literally just come in for the last quarter, and we conducted a survey in mid-March, but we hope to produce something for, I think, the week commencing the 4th of May, and we feed that into the Bank of England and lots of business groups, and it'll be sent to the Treasury, etc. But the numbers that we have seen will correlate onto this graph. Well, they don't really, because they actually go off the graph. It's the worst results in business confidence and economic confidence that we've seen since the survey began in 2014. People are working less as well, but a lot of the other indicators probably won't filter through into the survey responses until the next quarter, where sadly we are predicting a major drop off in earnings and day rates, as well as the amount of time people are working. So that information, the new report will be out hopefully in about 2 weeks' time. And yeah, you'll be able to find it on IPSE's website. So let me pass over to Ina, and she'll dig deeper into how freelancers are dealing with the coronavirus crisis.
Thank you, Ryan. So I'll start with giving a little bit of a background of the latest piece of research we did on the coronavirus outbreak and how it's affecting the freelancing sector. So in February time, we started receiving a lot of queries, both from the media, but also from our own members in the wider self-employed community around how the coronavirus outbreak is going to affect the sector, but also what kind of measures should be adopted to better support it. And when the situation started becoming more and more severe in March, we thought that's a good time to do a piece of research dedicated on this to see actually what's happening within the sector. And we opened the survey for 2 weeks between the 19th of March and 1st of April. And we got a really good response rate. We got close to 1,000 responses from freelancers, mostly working in the very highly skilled occupations. And we got people from a variety of different occupations, different pay levels, different gender and age groups. And what's perhaps interesting to mention for today's session, we got a really good breakdown between limited company directors and sole traders, we got close to 60% limited company directors and close to 40% sole traders. And that allowed us to draw some very interesting conclusions in the results about how the two groups differ and how the attitudes differ during the crisis. And in terms of the type of questions we asked freelancers about their attitudes towards the crisis, how concerned they feel about it. We asked them about the impact it's having on them, on their businesses and their incomes. And then we also asked them about their attitudes towards the different government measures provided. And as Andy mentioned earlier, one of the key schemes that was mentioned was the one that the Chancellor announced on the 26th of March. That's the SEISS scheme that limited company directors are unfortunately not eligible for. But we were lucky to have the survey opened a week before the scheme was announced and a week after. So we compared how the results differed and how the attitudes of sole traders and also limited company directors differed after and before the scheme was announced. So looking at the first key findings, one of the most worrying things we found out is that the 91% of freelancers say that they're concerned about the financial impact of coronavirus on them and their businesses. And that didn't differ on the basis of age group or gender group or occupation. And that didn't differ on the basis of limited company directors and sole traders. And that shows and illustrates the extent to which we're kind of all in this together, and the whole freelancing sector is very significantly affected by the crisis. And that's not very surprising. We can see why from the next slide. The coronavirus outbreak seems to be affecting the amount of work freelancers are doing, but also the stability of their businesses. And that all translates into their incomes and their personal circumstances. So as you can see, close to 70% say that the demand for work they do has decreased. And for over 50%, they say decreased substantially. And that was almost a month ago now. We can expect that the percentage is even higher as the crisis is becoming more and more severe. We can also see that 45% are saying that they might have to close their business if they don't get more support in the next 3 months. And another 45% are saying, which according to me, this is one very concerning stat, are likely to find themselves with no money to cover basic living expenses such as rent and bills. The situation did differ a little bit between limited companies and sole traders. We saw that, for instance, sole traders are a bit more likely to say that they're likely to experience decreasing demand for work, while limited companies are a bit more likely to say that they worry they might have to close their businesses if they don't get more support. So both groups are very affected, but in a slightly different way. And as we can already see, one of the key indicators on how freelancers are going to manage to financially adapt to the slowing demand for work is the amount of savings they have. So for 1 in 10, we can see that they have no savings, meaning that as soon as they start experiencing this decreasing amount for work, they would have to look for a certain substitute for their income. For another fifth, close to 20%, they only have savings for up to a month. It's already been over a month since the crisis began, meaning that that proportion are also already looking at different government support measures and other ways to kind of stabilize their income. And then most concerningly, we can see 66% either have no savings, so here we include that first group, or they have savings that could cover them only for up to 3 months. That's concerning because even those who are eligible for the SEISS scheme won't be able to access their money till June, which is around 3 months after the whole crisis began, meaning that they'll have to apply for some other types of measures such as universal credit in this interim period so that they manage to generate some form of income. And one a bit more reassuring fact here is that limited company directors tend to have a little bit more savings than sole traders. So on average, they have about 27 weeks of savings according to our data, while sole traders have 13 weeks, which is around half, meaning that one perhaps more reassuring fact is that limited company directors, for this reason, might be a bit better adapted for this very short period before they can access different types of measures. And then looking at the next slide, we can see how else the crisis is affecting the freelance sector. most of this we already mentioned. We are already seeing declining amount of work for freelancers. We are already seeing contracts being delayed and cancelled, people losing their clients. We already did speak as well about people losing their savings. What's new from the data here is that there's a significant proportion of people, around 40%, who would either have to withdraw money from their businesses or would have to register for income support. As I mentioned previously, the data is from a month ago, maybe that proportion is now even higher. But the difference here is that limited company directors that we surveyed said that they're more likely, they're the group that are more likely to have to withdraw money from their businesses, while sole traders, on the other hand, they're the group that are more likely to having to register for income support. And the final interesting thing here is that a small but significant proportion of the people we surveyed are already tapping into their long-term savings. We see that 14%, which is 1 in 7, are facing withdrawal penalties because they want to access their long-term savings, such as pensions or IPSEs. And that's very concerning because from what we know in the previous slides, there is a very difficult financial situation for freelancers in the short term, but it's already beginning to transfer in their long-term financial circumstances. For many, they're already accessing their pensions, and it would be very interesting to see in following up research in the next months whether this is becoming more severe and more people are tapping into their long-term savings and their pensions. And the final thing I'll speak about is how freelancers feel towards the different government measures announced. On average, 60% of freelancers don't think that the government support schemes announced would be enough to sustain them and their businesses during the outbreak. And we can see that the situation is very much different before and after the announcement of the SEISS scheme on the 26th of March, and it's very much different between limited companies directors and sole traders. So we can see limited company directors became much more negative after the scheme was announced. So higher proportion of them thought that government measures won't be enough to sustain them, while the opposite trend can be seen for sole traders who are of course eligible, at least most of them, for the scheme, and they felt a bit more positive. And I think it's a good time for me to hand over to Andy, who will speak a bit more about what's wrong with the existing measures and what kind of gaps are there and what can be done in future measures to kind of address this and perhaps try to help limited companies a bit more in future.
Thanks, Ina. A very interesting run through there from that still quite recent data, and Ryan too. And I think those two sets of stats really do bring home just how desperately worried people are at the moment, and that they should be. And that was a bleak sort of reminder from Ryan there that we are all in a lot of trouble here. And this is what we're trying to say to the government is we're going to need to help those people that have fallen through the gaps of these schemes, which I will now talk about. So we've already mentioned that the self-employed income support scheme, which was the big announcement from the Chancellor when he said I'm doing something for self-employed people, is not applicable to limited company directors. It's for sole traders only. And you know, quite a few people were surprised when they found that out. So there was quite a few people out there who saw that announcement from the Chancellor and they thought, you know, that's great, I'm included in this, and then they realized, oh no, because I work for a limited company, I'm not. Now, you've got to bear in mind that there are many, and Ryan mentioned this too, people in the creative sectors who perhaps work in, say, a cameraman or something like that, and they were kind of forced to set up a limited company, particularly those who were working in the BBC. There's a lot of talk around that a few years ago, how the BBC sort of pretty much pushed people into working through limited companies. To them, this limited company thing is not something that they particularly think about. It's something that they have to have in place to do some work, but they consider themselves as just self-employed. So they were really, really shocked to find out that they won't be included, because they're thinking, you know, I never really wanted this limited company, and now I find out that I'm excluded just because someone made me have it. So I mean, that I do feel very, very sorry for them, and I do think that they are in a particularly bad situation. Now, the other scheme is the Job Retention Scheme, or the Coronavirus Job Retention Scheme, CJRS. This is the one with the furloughing, and it's all about, mainly it's designed for employees, right? Now, we know that we actually knew this from the beginning, because we spoke to very, very, very senior people in the Treasury, and we pushed them into this position that it would be available to limited company directors, but not for their dividends because of the problem around dividends. So it only applies to the salary element of what they pay themselves. Now, the other difference of the SEISS scheme is that if you apply for the coronavirus job retention scheme, you have to furlough yourself. In other words, you can't work, so you have to stop working. Whereas if in the SEISS scheme, sole traders, they get the payment even if they are still working. There's no onus on them to stop working at all. It's just a boost to their payment. Indeed, some people will do very well in the SEISS scheme. It's a very generous scheme for those people it applies to, because they might still be working quite a lot and getting good income in, and they'll get the extra payment as well. So, we do think the SEISS is great. It's a very, very generous scheme, but it doesn't help everyone. And if you fall outside of it, you get absolutely nothing. And guess what? Limited company directors fall outside of it. If you do decide to make use of the job retention scheme, you can work outside of your own company whilst furloughed. So there's nothing to stop you as a director saying, well, I'm furloughing myself. It's a bit like how it works for an employee. Think of yourself as an employee of your own company, where if you were an employee of say a pub, and the pub shuts and they say, right, you're now on furlough, but you as an individual can go and work in Sainsbury's if you want to, where they're still hiring people. Yeah, so there's nothing to stop you from doing that and getting that additional income that way, and there's nothing to stop a director doing the same thing. So my company has furloughed me, my own company has furloughed me, but I can go and work outside of that company. The big question mark around the furloughing is exactly what can directors do whilst they're furloughed. So we've had it made clear in guidance that they can carry out the statutory duties that they have to do as directors. In other words, they can file company accounts, do tax returns, and that sort of thing. But what about, can you communicate with your clients? So, I mean, I spoke to one director of a company yesterday who has had to, they actually install blinds in people's houses. They can't go and do that work now because of the social distancing measures. So lots of their clients are ringing them up and say, well, what's going on? I've paid your deposit, all the rest of it. If they were to furlough themselves, are they allowed to communicate with their clients and say to them, look, don't worry, you're on the list. As soon as this ends, we're coming in. No, that's the sort of thing which isn't clear. Are company directors allowed to do some marketing for their own business in preparation for when the recession ends and the social distancing measures end? That's not very clear as well. What is clear is that you must not perform income generating activities within your companies. And I don't want to tell people here to do anything which is against the rules or that could land them in trouble. But what I would say is that as long as you don't do income generating activities, I actually think that you'll probably be okay. Now, what we want is for the government to make that clearer. So it's not probably you'll be okay, it's definitely you'll be okay. But that's the advice that, that we are giving at the moment. The main thing is you cannot earn money for your company. That's the main thing. So what are we calling for then? Well, look, the SEISS scheme has a cap of 50k. In other words, it looks back at your previous tax returns. This is for sole traders only, right? Bearing that in mind, yeah. And it says if you've earned more than 50,000 on average over the last 3 years, or if you've only got 1 or 2 years of doing a tax return, then they look at that. But if the average is 50,000, above 50,000, then you get nothing. There's no taper. Now we said there should be a taper. We said, look, if you're worried about that, then why not just make it once you earn over 50,000 you get 70%, once you earn over 60,000 60%, etc., etc., etc. Because the Chancellor, when he announced this scheme, said, look, only about 5% of the self-employed sole traders earn over 50k, and amongst that group on average they earn about 270 or something thousand pounds a year, because a lot of them are partners in law firms and accountancy firms and things like that. So he's saying we don't want to give money to those people because they've got plenty of money. That's basically what he's saying. But of course, if you earn 51k, that doesn't really help you at all, does it? Anyway, there is no taper. We think there should be, but there isn't one, right? A lot of people who are directors of limited companies, not all people, but a larger degree of people, if you look at the limited company director population, will fall into that earning over 50k bracket. So even if you were included in the SEISS, and even if they did account for dividends within the SEISS scheme, you might well still fall foul of that 50k cap. On top of this, directors are already being pushed towards the furlough scheme, the job retention scheme, for the salary element of their pay. There's guidance online. The government is basically saying to people, come and make use of this if you want to. So we think it makes more sense, if we're going to tweak one of those schemes, let's tweak the job retention scheme so that directors can make better use of that scheme. So that's what we're pushing for. We're not against the SEISS scheme being tweaked as well, but we want to see that 50k cap removed, and the government's giving no indication of that happening. The disadvantage of the job retention scheme is the furloughing bit. You don't get that in the SEISS, but you do get it in the job retention scheme. Okay, now what we're saying is that the job retention scheme should recognise dividend income in the calculation, i.e. we're going to give you 80% of whatever you might reasonably have expected to earn in this coming period based on previous earnings. We're saying pay now, claw back later. In other words, which I've already said, in other words, government is worried, oh, we don't know where the dividends have come from. Well, we're saying, well, don't worry about that. Pay people. They need the money now. It's desperate. Look at what we've just heard from Ryan, and look at what we've just heard from Inna about how desperately worried people are. Can we get some money to these people? And if we overpay them a bit, then we can claw it back later, or frankly, so be it. I mean, how many people who are limited company directors actually have dividends coming from share schemes as well? Some will, but is it a huge population that should ruin it for everyone else? We're actually trying to find that information out, and Inna and I have been working on a survey which we want to put out, trying to look into that. And as I said before, you could simply ask people where the payments have come from. So when people apply, you can say to them, okay, we can see you've earned X amount in dividends. Tell us where those dividends came from. And if you lie, you're in big trouble. And I think you'd get a very high compliance rate by simply doing that. So we're pushing the government to do this, and we've given evidence to the Treasury Committee, and we've since written to the Treasury Committee because the chairman asked me to. We've done that, and we've put these ideas down on paper. And that committee, I was led to believe, and you can watch it for yourself, the chairman gave me strong indication during that committee that committee was going to push the government on this very point as well. Now, I don't know if anything will change. I don't want to give anyone false hope, but that there are many people who seem to be saying, isn't it a bit harsh that we're just ignoring dividend income altogether because of this slightly technical hurdle, and couldn't we do something to get around it? Okay, so that's what we're doing on that one. Now, we also want them to revise the rules and the guidance to make it clear about what furlough directors can do. And as I said before, what we want them to do is to say you can do absolutely anything as long as you don't generate income for your company. I mean, actually, why not get rid of that as well and say you can go and earn money like you can in the SEISS scheme? But because this is a scheme for employees only, they're not going to do that, because they don't want businesses basically claiming the furloughing thing and then having their staff, basically getting the government to pay their staff's wages for them while their staff are still working for them and generating income for them. They can't do that. So under the job retention scheme, you will have to furlough, but we're saying make it really, really clear that as long as people aren't actually making money inside their own companies, they can make money outside their companies, but inside their own companies, then they should be able to do whatever they want in terms of talking to their clients, explaining, look, I've furloughed myself, but I'll be back in a few weeks, and, making sure that they can tee themselves up with some good work when the furloughing period ends. Couple of other technical things. One in particular is it's become apparent. So this scheme launched on Monday of this week, by the way. So we've got the first people actually applying for the furlough scheme now. It's up and running, and they've had, the last time yesterday I saw they'd had something like 270,000 people going through it. It seems to be working fairly well in terms of the user experience is quite good. You just put in the details and they say, yep, okay, you're going to get these payments. One of the things about it is that in order to make use of it, you have to have what they call an RTI event. That basically means salary has to be put through the real-time information system. RTI stands for real-time information system. It's just the PAYE software that you pay people through, right? So what the government said is that you had to have had an RTI event in the last tax year before March the 19th. That's the date that they're going on. Now, it's since become apparent that a lot of company directors might only actually have one RTI event in the year. They might make one salary payment to themselves just because it's easier, to do. They might make one salary payment to themselves, and they might do it right at the end of the tax year. Why not? Good time to do it, right? Which means that they're missing out on that. So we're pushing them to move that date to the 5th of April so that we can ensure that no one gets excluded on a technicality, which, by the way, I think is entirely it's just an unintended consequence of that date. So that would also need to change. We're pushing for that one too. And there is something about the calendar as well, and how we look at how many working days there are, which needs to be sorted out within that scheme too. So there's a lot of talk going on around that. If they don't want to do this, that we're talking about, all this stuff on, first of all, basically including dividends, pay now, clawback later, put in a question which asks people where these dividends come from, and then get money to people. If they don't want to if they're saying that the dividend problem is insurmountable, then we're saying, what else are you going to do then? Because you can't just do nothing, because there's too many limited company directors out there that have got no income coming in. Is there not something that we can do to help these people keep their businesses alive on life support, frankly, until this period ends, and then we can come out the other side and they're ready to go again? What we're saying is, have you thought about generous tax breaks? So there might be some directors who have got a pot of savings to pay their tax, which they may not have to do until next January. It would be very helpful if the government could make it clear there's going to be a very, very generous tax break, which would enable people to dip into that pot with confidence, knowing that they're not going to be left high and dry when the time comes. Or what about good old straightforward grants? Now, we've got grants for those companies with business premises. They're getting a grant. In some other country, in Wales, there is some grant. There's like a hardship fund where they're dishing out grants to businesses. Maybe we could look at some generous grant scheme which just gives people some money through some other way, not based on their previous earnings, perhaps based on the fact that number of employees they have, or I don't know, but there are other ways of doing it. So if you don't want to do the dividend thing and include them in the existing schemes, why not set up something specifically for limited company directors and give them some grant money? So these are the ideas that we are putting forward. We have put forward to the Treasury, and we are putting them forward. We continue to talk to them and put these ideas forward. And now I'm going to hand back over to Ryan, who, now that I've had my sort of rant about what we want to happen, Ryan's going to talk us through a little bit about what is actually out there right now beyond that salary element of the job retention scheme.
Yeah, and actually, just very quickly to build on what you were saying, Andy, before I forget, today is actually the deadline for the 18-19 tax submission, because obviously that was extended as part of the original set of measures outlined by the Chancellor, so you can put your tax return in late. Of course, if you want to be eligible for government support and you're self-employed, and you are eligible anyway, you'll need that tax return if you haven't put it in yet. So if either yourself or someone you know hasn't put their tax return in, remind them that today is the deadline, and I think we'll be tweeting it out and reminding people. The second thing is that
good point, Ryan. I mean, so that, just to clarify, that one is for the self-employed income support scheme, which limited company contractors or directors are not eligible for anyway, right? So that is a good message though for any sole traders who might be on this, or if anyone here knows some sole traders, if they hadn't already done their tax return, which they should have done by the end of January, but if they hadn't, if they were late or whatever, they had been given an extension until today to get that tax return in, and that would still be considered for this for the SEISS grant, for the SEISS scheme, but that's not for limited company directors. Thanks, Ryan. Go on.
And then just a second thing as well, thinking about what you're saying there, Andy, is that there's two caps effectively on the SEISS scheme with the 50k, and also of course you can get £2,500 per month from the scheme, but that doesn't apply to employees. So I mean, when we originally outlined our proposal for government, there was never a 50k cap. So if you did put something together for limited companies and include dividends in it, there's no reason why you just wouldn't put a £2,500 cap on it anyway, and people could only get a certain amount with the 80% thrown in. because there's people on very large wages that are employees that are being furloughed. I think even footballers are the one example being banned around. Some clubs in the Championship tried to furlough, I think, and they're still they can only get £2,500 a month anyway.
Yeah.
But anyway.
No, you're right, and that is, as I was saying, one of the reasons why it might well be better for limited company directors to be included in the job retention scheme rather than the SEISS scheme, because not all, but quite a few limited company directors will have earnings which exceed that 50k cap, which would exclude them from SEISS anyway.
But anyway, let me move on to some things that might be able to help you if you're not eligible for that scheme. And let me say as well that at the end of this, there'll be some questions, but there's also a slide with lots of links on, including a government helpline number that was set up specifically for small businesses and the self-employed. And we have a hub on our website with all this information and in a lot more detail. There's an FAQ page that we've been diligently updating as we've gone, and there's a lot of different information out there. So there's different kind of support available. I'll go for business first and then welfare support. So if you look at what the government have outlined, they put together a package of tax support, loans, and as Andy said, a few grants, some of which are devolved. So if you look at, there's the Coronavirus Business Interruption Loan Scheme was the first thing that was set up. That allowed people to apply for a government-backed loan of £5 million. And there's 40 accredited lenders, so you go through a high street bank for it. And there's a lot of advice on the British Business Bank website around that. Sole traders and limited companies are eligible as long as business activity is operated through a business account. It's very crucial. And businesses must generate more than 50% of its turnover from trading activity. There's no fees or interest in the first 12 months. Originally was 6 months, and then they revised it. So I think there is appetite out there in the government to change some of these dates. So hopefully we'll see that as well. But it's uncapped after the 12 months. Personal guarantees of any form will not be taken for loans below 250k, because there was a talk of mortgages being used at one point, which is obviously not what the government wants and not what anyone really wants. But there is a bit of concern out there that obviously if you're not making any income, applying for a loan is perhaps not exactly what you want to do as a business, because you may not be able to pay it back, of course, if things do go badly. There's help with taxes out there that government have put in place. So your self-assessment tax return payment due on the 31st of July can be deferred until January 2021 next year. VAT payments for the 20th of March 2020 and the 30th of June 2020 can also be automatically deferred, and that means that basically if you don't pay them, they'll just be rolled over, so you don't actually have to do anything. The HMRC have set up what they call time to pay arrangements, and that's also to do with the helpline, and effectively it's for people who are concerned about paying their taxes. You can talk to them and sort of arrange when that can be done that might be easier, more equitable, etc. And companies also apply for a 3-month extension for filing their accounts to Companies House. And a lot of that information and the links will be on our website. There is grant funding out there, and a lot of that is done through local authorities. So originally it was through England. The government set up a scheme specifically for England, and they've given more money to Scotland, Northern Ireland and Wales separately to do with how they please. And in England there's a one-off grant of 10 grand for eligible businesses. It's mainly for business costs. But they must be in receipt of small business rate relief or rural rate relief and be a business that occupies property. And I know there's been as well a lot of hardship funds have been set up. So these are either usually industry based, or they are through a local authority. So I think some of the first councils that come out with them were Coventry Council and Sheffield Council, and they've set up hardship funds. But there's also a lot of industry-based hardship funds being set up, particularly in London. Particularly the creative industries were very quick off the mark to do this. And so, for instance, the BFI have a hardship fund for freelancers, mainly actually. And that's, I think it's about £3 million in there that you can apply for. BEC2, a kind of trade union for self-employed freelancers in the creative industry, they have set up a similar fund. And more of those sorts of things are being set up as we speak. And there is other support, of course, as well. You can refinance lending, perhaps potentially with your bank. Overdraft charges, I think, have been dropped for the first 500 quid. People can apply for mortgage holidays. It's harder to be kicked out if you're a renter by a landlord. Council tax can be deferred, and there's other measures are being outlined in the devolved nations, which are slightly different. And all of that information, as much as accurate as we can keep up to date with, is on our website. So moving over to welfare support, of course, the main thing that people will be applying for if they are, you know, in need of it is universal credit. There are a number of different stipulations. However, the government have raised the amount of money you can both claim and how easy it is to claim, because traditionally you'd have to go to a job centre. If you're self-employed, they also apply something called the minimum income floor, which is a arbitrary calculation based on how much money they think you should earn. They've removed that. IPSE have been campaigning for that to be removed for a number of years now, so we're very pleased, although not in the circumstances. But eligibility for universal credit is quite complex in some places. So if you're on a low income out of work, over 18 and under state pension age, you can apply for it. However, if you have savings or capital over £16,000, you will not be eligible. And if you have savings or capital between £6,000 and £16,000, this will also be factored in. So obviously, a lot of self-employed people will be putting money aside for tax returns, and that could potentially be counted, which, you know, and £16,000 in regard of, you know, a lot of people we speak to, if they have been putting money aside for tax, you know, that could really stop you from being able to apply. And there are several different calculators out there, again, can be found via our website. Standard allowance for universal credit has increased, both for single claimants and for couples. And you can crucially claim universal credit whilst waiting on other types of support, including the self-employment scheme. That includes limited company directors, even whilst furloughed. There is something else that's not on this slide, which I didn't consider until this morning, but actually there's also a 2-child limit on the amount of money you can claim, which is still in place. And there's a lot of very good information. We do have some stuff on our website, but if you're particularly concerned, the best people you speak to, I guess, is probably your local councillor or Citizens' Advice for very specific universal credit related queries. There is other support out there as well. The employment and support allowance, which is mainly to do with sickness, has been raised, and that's about £73 a week for those that are over 25. So there is a lot of support out there for people, both in business and personal capacities, but obviously we think there should be a lot more. There are people that will be falling through the cracks, and we haven't really mentioned, you know, people that are newly self-employed and people that have had maternity gaps and things, who also are finding it hard to claim government support of all different kinds. So yeah, I think we're basically done. There's a lot of links on the next slide, which you can go to, and he's put some new ones in as well, and we can look at questions as well.
This is the death by link slide, but all these links will be sent to you with the feedback forms, which I think you're going to get an email tomorrow, so you can find them on there. But you can, if you want more information, you can sign up to our newsletter, check out our website. As Ryan says, we're keeping it updated on the coronavirus pages. If you're not already an IPSE member and you want some more information on that, you can find it there. We're also asking for your case studies, so if you if you want to tell us about your experience, then please send that in to us, because we can use that to show government about just how difficult people are finding it out there. So that email address, covid@ipse.co.uk, is there. The report and research that Inna talks us through is there in the IPSE coronavirus report link. And that thing I was going on about with IR35, there's a bit more information about contacting your MP on the IR35 issue there. And finally, the government helpline number is there. Now, we have basically used up all our time, but we will try to answer a few questions. I don't know if there are any burning ones, Ryan or Inna, that you've seen that have come up, or frequently asked questions that we could address.
There's a couple which we get anyway from limited company directors contacting us, and I think there are a lot of grey areas around it, but to do with how potentially these schemes might interact with IR35 moving forward. I know you've covered it, but also how, like for instance, if the dividends thing was rolled out, would that affect IR35 later down the line? And also, we got a lot of questions, both on this webinar, but other webinars and via our email address, about how much work you can do around furloughing. So you might want to go over that, and how much and how it interacts with other support.
So, on the IR35 thing, a lot of you may have noticed that when the Chancellor rolled out the self-employed income support scheme, at the same press conference, he did say, you know, and because we're giving you this generous scheme, we're going to look at the national insurance rates that you pay. Basically, he's going to put up tax. We're going to get more tax out of you in the future. This did ring some alarm bells with us, because it made us realise that if there was a greater degree of support given to limited company contractors, that they would continue to try and get more tax out of them as well. Now, the government are already sort of determined to do that anyway with the IR35 changes. We at IPSE are going to spend the next year, when we're not talking about coronavirus, talking about the IR35 thing and explaining to the government why they should not do the IR35 changes. It may be that they would say to us, if they did give a generous package of support to contractors now, they would say, well, we helped you out, you know, we gave you a freebie, and now it's time for you to pay your dues, and we're definitely pushing ahead with the IR35. We are conscious of that, and one thing that I would say is that we would never make an agreement like that with the government. We would never ever say to them, okay, give us some cash now, and we'll keep quiet about IR35. So we wouldn't accept that. But what we're saying is the two things are totally different. People need money now because there's no demand. They've got no money coming in. So what can you do to help them? The tax system's really got nothing to do with it. That's another thing entirely. And by the way, we think that the tax system is terrible for contractors and for all self-employed people, and we think it should be thoroughly reviewed. And probably first on the list is IR35, because it's a total nightmare. No one understands it, and it's destroying businesses and it's killing work opportunities. So yeah, let's get rid of IR35. We can then put in place something much more sensible, and we also could do with some very clear rules around who is self-employed and who isn't, so that we can understand, and we can marry up the employment status and the tax status of people. So yeah, there's a whole piece of work to do out there on tax and on IR35, which the government needs to address anyway. But there is a bit of a link potentially, but as far as we're concerned, any help that's given to contractors now does not mean that we will all accept IR35 when it comes in. If it comes in, we're trying to stop it. The other thing you asked, Ryan, was about furloughing and what work you can and can't do. So this link isn't here, but if you go on to the gov.uk website and you put in the coronavirus job retention scheme, there is a whole load of guidance there, which has changed about 4 times, of course, because to be fair to the Treasury and HMRC, this is an entirely new scheme and they're trying to work out the boundaries of this and how it's going to work. But there is specific guidance in there for company directors and what they can and can't do whilst furloughed, but there's still quite a few gaps in it. And it's things like, can you talk to your clients, that I think is really missing from that. What we want it to say is you can do absolutely anything you want to do to help your business, you just can't generate income. Basically, you can't send someone an invoice, but if you anything else you can do, that's what we want it to say. Any other questions, Ryan? Sorry, I can't see the questions, I'm afraid, because of the way that this works. So we have to do it in this awkward way. So Ryan and Inna are trying to find them.
Yeah, Inna, have you seen any specific
I've seen
ones?
a couple of ones around the eligibility criteria for the different schemes. So for instance, there's a couple of people asking whether they can apply for different schemes if they're still working but have very reduced amount of work, but yet they have 1 or 2 days a week still working. Can they still apply for different schemes?
Yeah.
Yes.
So
the answer, so that's a classic difficult one with the furloughing thing, right? So in the self-employed income support scheme, which is for sole traders, yeah, you can carry on working, doing as much work as you want, and you'll still be eligible for that scheme. In the job retention scheme, you have to furlough yourself, so you can't do any work at all. So you can't do 1 or 2 days work. Now that's a problem, because people want to keep their businesses going, you know, and if they've got one good client who is saying to them, are you available to do a bit of work? They don't want to say to them no. they may well have spent years building up that client base, and it's all about being available to do the work. That's what your business thrives on. If you turn around to them and say, no, I'm shutting down for a few weeks or months, then that client will go off and find someone else, and then you miss out. And this is the problem with the furloughing. But the way it works right now, you cannot do any work for your company. However, you could do work potentially as a sole trader for that same client, as long as the money doesn't go for your company. You know, this is where it gets a bit confusing. I mean, could you even set up a different company? I mean, this is where you're going to get in. You'd have to tread very carefully there. But certainly, you could go off and find an employment somewhere whilst furloughed from your company. That's definitely true. So there might be some ways around that, but the general rule is, if you furlough yourself and apply for the job retention scheme, you could not do 1 or 2 days work for a client and generate income for it. I think we might. Is there any other burning questions, Ryan? Because we're 5 minutes.
Carry on what you were saying, because also, of course, you can. I mean, even in normal times, you can work up to 16 hours a week and still claim universal credit. And I think I'm not sure if that's been relaxed or anything, but yeah, I mean, you can still be eligible for universal credit and still be working. You could even be a sole trader, get some support, still have the odd bit of work, and still claim universal credit, actually.
Yes,
which is
what they've done on universal credit is they've removed this terrible part of universal credit called the minimum income floor, which assumed that you had a certain level of earnings as a self-employed person. It said, well, we're going to assume that you're earning at least minimum wage, working 40 hours a week or something, and then we'll top up from there. They've removed that now, so they don't make any such assumption. So it makes that a bit more generous. I mean, we were saying they should remove that anyway, but it does make that scheme, or universal credit, a bit more generous. Okay, I think we better end it there, because we are sort of at time. So yes, this will be This has been recorded and will be on our website later today. And tomorrow you'll get your feedback forms with all the links that you can see in front of you now too. Thank you very, very much for listening and sending in your questions. We've had well over 300 people on this webinar, and there's no way we could have answered all of your questions, but thanks for listening, and I hope that a lot of your questions have been addressed. Thank you. Bye.